Hi, welcome back to the channel where we break down key financial concepts for students and professionals just like you. In today's session, we're diving into the dividend payout ratio, a crucial metric that helps you understand how much the company's earnings is going back to shareholders as dividends. Whether you're preparing for exams or applying this in real-life scenarios, this concept will sharpen your financial toolkit. Let's break it down with an example that brings theory into practice. Let's dive into it quickly as we look briefly into this finance or financial metric. Okay, let me share my screen. Gone, mini me, now, as I usually humorously say. Okay, so the dividend payout ratio, also known as dividend earnings ratio, measures the proportion of a company's earnings that is distributed to shareholders in the form of dividends. This ratio helps investors understand how much the company's profit are being paid out versus how much is retained for growth and reinvestment. So in the form of dividends per share, dividends are declared for shareholders, while earnings per share are the amount of ordinary shares that are divided after the profit after tax or the bottom line, the net income, has been accounted for. So this ratio is a key indicator for income-focused investors who rely on dividends as part of their return on investment. So on a year-on-year basis, some shareholders are very meticulous and critical about their investments yielding returns in form of dividends and how much the earnings of the company have been converted to dividends for these shareholders. So the formula is on the screen. Is typically the numerator as dividends per share and the denominator as earnings per share. Where the dividends per share is calculated, which we just looked at in the previous video, as the total dividends divided by the number of ordinary shares held by each shareholder, or the units held by each shareholder, culminating in the total shares for the company at a particular period. While the earnings per share is the company's net income divided by the number of outstanding shares. Okay, so let's look at an example and how to calculate this ratio very, very practically. Still, the company we've been using, Shariputu Nigeria PLC. We have the profit after tax, like you've seen, which we've taken and we've calculated the earnings per share. We've also, from the SFP, taken the total dividends to calculate the dividends per share, and we've deducted the preference dividends from the profit after tax when we're calculating the earnings per share. So let's go to our solution book. If you can see my screen, we've calculated the earnings per share, which is 13 kobo. We've also calculated the dividends per share, which is 28 kobo, the previous videos. Excellent. So let's go now and calculate the dividends per share. So by way of dividends per share, we just pick our dividends per share totally here and we paste it practically here. So we have have 28 kobo is our dividend per share. Let's go and pick our earnings per share, which is 13 kobo, and paste it here. So our dividend payout ratio is calculated as our dividends per share divided by our earnings per share. So we have it as a percentage of 220%. 220% dividend payout. So based on this, the dividends per share and what was paid out of earnings is about 220% of the earnings per share of the company. So what does this mean? What does this mean? It means that the dividend payout ratio reflects what percentage of the company's earnings is being returned to shareholders in the form of dividends. The higher ratio indicates the company is returning a significant portion of its earnings, whereas a lower ratio suggests that the company is retaining more of its profit for growth and other purposes. So, in the case where 220% were declared, at least 100% is supposed to be declared from the earnings, but then I'm sure the company has prioritized payment of dividends to shareholders, whereby even the retained earnings have been taken out of to pay shareholders. So for shareholder 2 to have 220% declared above the 100% of the company in that particular year, then retained earnings must have been tapped into to settle shareholders. This may be risky, but then it depends on the dividend policy of the company. Most investors that are keen to earn dividend every year from of their return on investments may be the reason why the company declared 220% dividend payout for that particular period. What is the implication? A high dividend payout suggests that the company is distributing most of its profits to shareholders. While this can be attractive to income-focused investors, it may also imply that the company has limited reinvestment opportunities or is not prioritizing growth. So this may be the reasons why we have high dividend payouts, like you have 220% in a particular financial year paid to shareholders, or they have accumulated the retained earnings over a period of time and decide to declare it at a particular financial period or financial year. It's a possibility. While a low dividend payout indicates that the company is retaining a large proportion of its earnings, which may be used for expansion, paying down debt, or investment. However, this could also mean fewer dividends for shareholders in the short term. So where you have low dividend payout, these are the possibilities where expansion is prioritized, settlement of debts, reinvestment to broaden the revenue base of the company. So this may be the reason in the short term, and in the long term, it will be beneficial to the shareholders. So what are the causes and effects? The causes of a high dividend payout includes mature businesses with stable earnings but limited growth opportunities tend to pay out higher dividends, and these are the reasons. So a high dividend payout may scuttle other goods, but make shareholders smile to the bank. It depends on the policy and general practice of that company. What are the effects of a high dividend payout, like we've seen about 20% for Shareholders Nigeria PLC? It may attract income-seeking investors, but can raise concerns about the company's ability to invest in growth or cover future obligations if profits decline. So these are the effects. Of course, investors love high returns, smiling to the bank, but it will scuttle the growth of the company. And future obligations may not be able to be met if profits decline in future. While a low dividend payout, it causes a growth-focused companies that prefer to invest earnings into the business rather than distribute large dividends. Depending on their policy or the board's decision, they could decide to claw back these profits to grow the business. And the effects can attract investors looking for capital appreciation rather than income, though it may disappoint those seeking regular dividends. These are the effects of low dividend payout. In conclusion, the dividend payout ratio is a crucial metric for understanding a company's dividend policy and its balance between rewarding shareholders and reinvesting in growth. A high ratio appeals to dividend-focused investors, while a low ratio may indicate a focus on reinvestment for future growth. The ideal dividend ratio depends on the company's stage of growth, industry, and I'll add policy. Then the overall financial strategy matters. So this ideal dividend payout depends on the company's growth and retention strategy, the industry where the company is domiciled, the policy of the company, the board of directors, and the shareholders, all stakeholders involved in the overall financial strategy of the company is key in determining dividend payout. This is very important. All right, having looked at this powerful ratio, that's a wrap up on dividend payout ratio. Remember, this ratio isn't just a textbook formula. It's a powerful tool for understanding how companies manage profits and growth, whether you are studying for exams and using this in your professional life. Keep it in mind as you analyze company performance. It's very, very important. Okay, so if you found this video helpful, make sure to like, subscribe, hit the bell for more insights. Drop your questions and thoughts in the comment section below. I'd love to hear how you're using this in your studies and the workplace. Until next time, keep learning and keep growing. See you in the next video. And until then, bye for now.